All right, welcome everybody. This is the first of what we hope to be many discussions that Jeff and I can walk through as we try to share valuable pieces and tidbits on how to build businesses effectively. One of the things that we've learned over time is how variable the board meeting can be, how the topics can vary from here to there, even board meeting to board meeting. And we've developed in-house a great template that has facilitated great framing for data, great discussions for key initiatives, and we wanted to share that today. And hopefully it's a useful tool for the audience to use as they work through different topics as a board, but also work to build businesses predictably, efficiently, year in, year out, quarter in, quarter out. So I'm joined by my colleague, Jeff Todd. We work together on the later stage strategy at Sorenson Capital, and we're excited to walk you through this today. Jeff, great to be with you.
Likewise, Brady, excited to talk through this. Maybe to kick off, we spent a lot of time thinking through the order of the discussion at the board meeting, right? What do you start with? What do you end with? And everything in between. So to start, let's jump into the agenda and walk us through how you thought about what's most important to start with, and we can go from there.
Yeah, absolutely. So it's really important within a board to set the table in a way that facilitates consistent understanding across everybody in the room. Management team, board members, board observers, because otherwise you're spending way too much time just trying to get people on the same page. So the way that we did this was to structure the discussion around a prioritization of what the key initiatives are or the key priorities for the CEO, and then to frame the business. What's the financial performance of the company? What is the product initiative? What are the product initiatives and how is the product evolving over time? And then once you understand the performance of the business and the product dynamics, then you can go into, okay, are we getting the product to market efficiently? Are we growing at the rates that we need to grow at? Are we pulling the right levers to create value for the shareholder base? So you'll see that structured conversation. The go-to-market discussion will kind of take two parts: how leads are generated and then how leads are closed and what that looks like. Once you understand kind of product performance, go-to-market effectiveness, then you can get into some of the post-sale effectiveness of the business. Are customers happy, right? Are they being served in the right way? Are we delighting our customers, right? Are we driving ROI? Things like that. And then the wrap-up at the end of the discussion is around people. Obviously, people drives the success of any business, and so we want to have a good discussion there. But structuring the dialogue in that way enables a boardroom to be able to go through a conversation in a way that's going to facilitate the right dialogue. So that's why we did this way. It's not like these sections are magical or anything else. These are very common, but going through the discussion in that order, we found to be very effective.
Absolutely. And, we start off here, call to order and approvals, get some of the more administrative tasks out of the way. And then we start with the CEO's view of the business. Maybe tell us a little bit. Sometimes we like to have the management team in the room for that CEO section.
Right.
Sometimes we prefer to have it just with the board. But I'll click through there as you're talking through some of those points.
Yeah, for sure. So the short answer on this is it really depends upon the culture of the business. Some cultures are very open, very transparent, right? Feedback is part of the dialogue. There's other cultures that are a bit more cautious, right? It's like, okay, we're going to package this up. We're going to make sure that we communicate very carefully when we're providing feedback or driving for change or what have you. So just depending upon the nature of the team and the business, it could go either way. But it's very important at the beginning of a board discussion for the CEO to be able to say, okay, here are my top 5 initiatives at this point in time. Here's how the business is being managed, and here's what I think are the most important things to happen. So the very first slide out of the gate is the opportunity for the CEO to walk through that. And this slide in particular, you'll see in a number of different places across this discussion. But what we've tried to do is say, okay, what are the key objectives? Are they new objectives? Are they continuing objectives, right? Is there something that's been completed that was high priority? And then what are the descriptions, the bottlenecks, the status of the key priority for the CEO? Again, this is an opportunity to say, we're not going to dive into financials. We're not going to dive into problems. We're going to level set. What are the most important things that are happening right now that need to happen over the next quarter or month or week or whatever in the eyes of the CEO? I think it's a very important discussion to have right up front. So that's kind of how we went about this first slide, right? Level set, give the perspective from the top.
Yeah, and what I think is really interesting is because we forced the CEO to narrow it down to just 5 things, it tells the board a lot about what's on here and also what's not on here, right? Maybe, we as investors think something's particularly important and it doesn't show up in the CEO's top 5 priorities. That's a big flag for us to say, interesting, tell us why this may not have made it onto your list, for example.
Yeah, absolutely, right? And it's a good opportunity to challenge assumptions, both for those who are not on the management team and vice versa. And it creates a lot of unity in perspectives because right up front, okay, we're focused on this. This is less of a priority. How do we ensure that we're aligned there, right?
Yeah.
So that's great.
Great. Well, the next one on here, we move from priorities to how the CEO would score the rest of the management team. And again, the management team can be in the room for this or not. It's really up to the CEO, but maybe talk us through how you thought about this slide and why it's so important.
Yeah. So, this is an interesting topic. I think there are perspectives here that go on either side of the spectrum, but the construct is, I think, really valuable. And that is to say, hey, this isn't about pointing fingers. It's not about calling people out. This is an opportunity to say, hey, the success of the business, now that we know the priorities, the success of the business is going to come down to the teams that are tasked with carrying out those priorities.
Right.
And so where are we strong? Where are we not strong? Where are the holes in the organization, or where are the areas that need to be strengthened? And to be honest, this is going to ebb and flow, right? Yeah. So this is as of a point in time. We've got some examples here. Don't anchor too much on the letters on the page, but it's an opportunity for the CEO to say, hey, I've got a real need in this particular department. And this is what we're working on and how we're going to solve this. And I anticipate this moving from a C+ to a B+, over the course of the next couple of weeks. But it really provides clarity as to how the CEO is thinking about areas that need to be lifted and supported, right?
Absolutely. And it also gives the board the opportunity to understand where there may be places that they can jump in and help, whether that's helping hire a new leader, whether that's they have previous expertise in one of those given areas. It's an opportunity. Again, the board meeting is all about how the board can help the management team continue to perform well as a business.
Right. Yeah, absolutely. So with that, you get a really good level set starting point, right, with the CEO. You understand the department level. You have a great discussion around priorities and follow-ups from prior discussions and so forth, even before you get into any of the reporting that's typical.
Okay, great. Now that we've covered, that initial section with the CEO, would love to jump into the financials, and help understand how the business should frame itself, both to the board and also for the management team.
Yeah. So this is critical, right? So every board discussion has a financial overlay. But those financial overlays are highly variable, right? There's all kinds of different cuts at the data. Different folks have different preferences as to how to show the data. There may be mixed incentive structures in how the data is shown. So what we're trying to do is be very deliberate. So what I want the listener to take away from this is we didn't just slap a bunch of charts on slides. There is a very deliberate purpose behind the data that is shared, the way that it's shared, the order in which it's shared. And we would anticipate and encourage folks to use this same reporting structure, board meeting in, board meeting out, with the same historical data. Because if you do that, then you get through this financial section and everybody sees the business in the same way. And folks are going to highlight different things or have different concerns or different areas of opportunity, but there won't be that misinterpretation of how the business is doing. So as we go through this, we'll try to explain some of that deliberateness.
So this first slide in the section is going to look very similar to the rest of the sections. We always have the department leader start with the accomplishments that they had from last quarter, right? It gives that product leader a good chance to tell us what they did. And then the next slide after that is what they're currently working on, similar to what the CEO tells us to start the board meeting.
Yeah. It's a concept that is consistent, and you'll see this in the slides, right? But again, if I'm the leader and I communicate my key accomplishments, I'm communicating two things. Number one, I'm clearly communicating what I did, but I'm also communicating what I didn't do. And if I was nervous in finance and accounting, for sake of example, about a system transition, and that doesn't show up on the accomplishments, and I know that that was something that was in the works, it gives me an opportunity to say, hey, it seems like maybe we're getting delayed on this. How do we remove this bottleneck or what have you? So it's a really good opportunity for both the management team and the board to align on kind of what's happening. So it's always great to have some rah-rah. This isn't intended to just be rah-rah. This is a great communication vehicle so that everybody understands what's happening and what's not happening in the org.
And one other thing we didn't touch on at the beginning, but I think is important, is a lot of times, we'll get the board deck the night before the board meeting. It's actually really important to get the materials to the board members a week in advance, right? And that way everyone can come to the board having read the materials, you can cover the key accomplishments, and that way you can really get to the meat of what's important to discuss in the limited time you have in the board meeting, rather than, sometimes we get in a board meeting and it's a lot more focused on accomplishments rather than to-dos or how the board can help going forward.
Yeah, absolutely. So the next page in this section, it should look very familiar. We like this sort of prioritization initiative structure. Again, you've got existing initiatives, new initiatives, completed initiatives, but it creates this ongoing prioritization. When is this anticipated to be completed? Has it been completed? What are the bottlenecks? Certainly helpful for accountability, but it's also intended to facilitate bottleneck removal with the help of the board, right? So you'll see this structure on this page over and over again. But with that, maybe we dive into the reporting itself.
Let's do it. And I'll go to the next slide. As we go here, maybe before we jump into the actual metrics, Brady, walk us through some of the concepts around how we like to look at data in the board deck and why that matters so much.
Yeah, so you'll see in the upper right-hand corner of this slide that there are 6 different sections, okay? And this is intended to be very deliberate, as we talked about. First and foremost, enterprise software, B2B software, the companies that would fit this template, first and foremost need to be concerned about the top line trends of the business, ARR, revenue growth, and so forth, right? And everything else kind of follows in as part and parcel to value creation. So we start with top line trends. After we understand the top line trends, then we're going to get into some of the drivers that will ultimately impact top line trends in the future or efficiency in the future. So what you'll see is top line trends, then we'll get into new logo and retention, which is kind of the next double click. Then we'll get into system efficiency, which kind of looks at the whole business and what's happening with the dollars that are being invested. After system efficiency, we look at the rest of the P&L so that you understand where dollars are going and why. Then we look at cash flow, right, which is sort of an amalgamation of all of those different inputs. And then lastly, we're going to look at actual value creation, okay, which is a topic that is sort of assumed, but often never really directly addressed in a board discussion. But that's kind of the organization of this. So as we walk through these slides, it's okay to make tweaks here and there, right? But the concepts should be consistent, where you go through these different concepts at a step at a time so that you can build to the understanding you're trying to get across the room.
Yeah, absolutely. Then there's 2 things I'd call out as we get into these metrics. The first is we want to look at data over time. Right? You don't just want to see a quarter without any context of what happened a year ago, a quarter ago. So we always try to look at data over a period of time, 2 to 3 years. And we also try to look at data relative to what our objective was, right? Whether that's your budget, whether that's your forecast. But having that context around your budget and historical performance is really important. And a lot of times we don't get that.
Yeah, that's very well said, right? You'll see this consistently over and over again. We're not just data geeks. There's really, there's a very valuable toolkit where when you show historical trends, you understand quickly, the eye sees quickly where the issues might be, right? Yeah.
And let me touch on one more thing, which is in here we've got monthly data. Do we care about monthly data versus quarterly data? How do you think about that level of granularity?
It's a great question. So this is a whole other topic for another podcast, but generally speaking, one of the key drivers of success in any business is how fast the cycles of execution are. And if the cycle of execution is quarterly, it's going to be a painful ride. So we show monthly data here. We often encourage our teams to think about weekly engagement, right? Weekly changes, weekly adjustments. But from a data tracking perspective, I think monthly is a great balance.
Okay. With that context, setting the stage, let's jump into this slide and some of the metrics here that are top line metrics that we like to see in the board meeting.
Yep, absolutely. So again, a lot of this will be very familiar to our listeners, but upper left-hand corner, you've got monthly ARR waterfall. So this is the ins and outs of the ARR movement, right? So this is going to be increased by new logo, expansion. It's going to be decreased by downsell and churn, and then you're going to have a net number. Understanding how those components are moving instead of just the ARR figure is really helpful, right? So you'll kind of see the stacked bar approach. That's been a great way that we've found to track the data over time. Ending ARR on the right-hand side is the same data, but it's compared to budget, and then it shows the year-over-year growth rate, right? So if you see growth rates starting to move, if you see comparisons to budget starting to move, you can engage with the business in a higher level to sort of get ahead of what's happening, right? Bottom left-hand side, we do want to make sure that ARR is translating to revenue. This is a big topic for a lot of companies. And so monthly revenue trends versus budget, LTM revenue trends versus budget, also very important. So start at the top, understand the top line trends, and then once you understand those trends, let's get into new logo and retention.
Yeah, exactly. Great. Well, let's take us down to the next one. On here, we've got some of the more details around the composition of ARR and revenue as well.
Yeah, absolutely. So this is another dynamic that we've seen in different businesses over time. If ARR is growing, that's great. There's different celebratory thumbs up dynamics depending upon the underlying trends of the business. Okay, so for sake of example, let's say that the business is serving enterprise customer base and the expansion is very high. That's fantastic. You still have to ensure that you're hitting new logo goals, or ultimately you will plateau, right?
Yes.
And so there's a good balance there. So top left-hand corner of this chart or of this slide is monthly revenue by type. It's often the case that you have different types of revenue, most of which is traditional recurring revenue, but you want to understand that. Top right gets into new logo dollars. So dollars from new logo accounts and what the growth rate is in new logo ARR over time. So again, leading indicator, if new logo growth starts to come off, it's going to take a minute before you see that in the ARR line holistically. But you can act quickly if new logo growth starts to move. So we want to understand that. The bottom half of this chart, retention, obviously very common metric. We calculate net and gross retention a couple of different ways so that we have a little bit more leading indicator with the last 3 months versus LTM, but critical metrics of the business.
Totally. And on this slide, if you had to pick one of these, do you care about one of these more than the others, or all are important?
Certainly everything's important. In any business that wants to have long-term decades of success, gross retention is critical. Being able to demonstrate that the customer is being well served by the product is really important. So I would start there. Right after that, though, are these other 3 metrics, right? I think it's really important. And the reason why we bring each of these metrics in consistently, right, is because they each have a place. None of this is just reporting for reporting's sake. This is really critical inputs that should drive discussion and decision-making within the board.
Absolutely. Absolutely. Okay, well, that's the top line. From there, we like to dive into the system efficiency. Maybe tell us a little bit about what we mean by that.
Yeah.
And we can walk through some of the metrics we use to track system efficiency.
Yeah, absolutely. So there's a couple of different categories we'll talk about when we walk through this slide itself, but there's 2 concepts that you and I talk about quite a bit. One is unit efficiency, which is how the product is placed in market, the go-to-market efficiency around a sales unit. And we'll talk about that a little bit later in our discussion today. But zooming out, the whole system, the whole company as a whole needs to achieve efficiency in its go-to-market motion. The underlying assumption is that most companies are burning cash if they're growing quickly. And so if cash is being burned, we need to have a deep understanding for how efficient we're utilizing the resources that we have. So let's talk about how we measure that. There's a fairly traditional way to measure that, which is the top 2 charts, CAC payback and sales and marketing efficiency, which is effectively a return on dollars spent to get new ARR. I like CAC payback. I'm a little bit biased there. We do include customer success. in the calculation, but you really want to understand, okay, all in, all the dollars I'm spending to get new customers, how quickly is that coming back to me, right? So that's a really good place to start. If you zoom out even further, you want to make sure that the system is efficient from a value creation perspective. And that's where rule of X or rule of 40 or rule of whatever number your target might be can be really valuable. I think we've seen over the last 15 years that growth continues to be valued higher than cash flow. We've included both metrics here because I think it's a good balance to think about the business. But the combination of those two, I think, is a good measure of the system, of the go-to-market system itself, and then the holistic business system from an efficiency perspective.
Yeah, exactly. Okay. From there, we really try to get into, there's some more metrics around system efficiency, and that's really around this concept of ARR per employee, ARR per customer, and how quickly or how well you're adding new ARR, and how the contract value of that ARR that you're adding compares to what you've been adding historically. So maybe walk us through some of those on here.
Yeah, so there's inputs to system efficiency, and they're almost endless, right? But one of the key inputs is, regardless of how big the ARR per account is, or the ACV, that could be millions of dollars, it could be $10,000, it could be $3,000. Regardless of that dynamic, being able to understand, okay, how many people does it take me to achieve the ARR and the ARR growth that I'm achieving, and how do I think about that, right? So that's what these metrics are intended to do. What's happening on my average ARR on a last 3 months basis for my new deals? So how's my ACV kind of trending over time? But then in conjunction with that, how much ARR do I have per employee? And am I spread, sort of super thin, and I'm paying people X amount of money, and I'm only generating Y amount of money in ARR? There's a good level set to kind of understand the trajectory of the business, and these are important inputs to system efficiency itself. So average ARR last 3 months, pretty straightforward, just how your new accounts are trending. You can also look at that from a revenue per customer basis. It's going to be a little bit more lagging, but a helpful indicator as well. And then ARR per employee. So again, just understanding some of the key inputs there. The bottom right-hand side also is important in the sense that if you've got customer counts that are growing at a higher rate than your ARR, by definition, your average revenue per account is likely dropping. So you just want to understand, okay, what's kind of the state of play as it relates to my efficiency drivers at a system level. So that's what this page allows you to do.
Right. And again, the reason we have these here and the reason we go so in depth is because each of these are inputs ultimately to revenue.
Right.
Right. And so as you break down the different components of what drives revenue, hopefully you can see the trends and then adjust as you see those trends to either increase revenue or avoid churn as it comes up from customers, for example.
Yep, absolutely. So that's the system efficiency point. The next section of slides is around kind of the rest of the P&L. And I want to be careful with this as we talk through it, because again, none of this is just reporting for reporting's sake. We're going to go into some of the buckets of the P&L. The reason why we're doing that is because it's very important as a business scales that operating efficiency is realized. Okay, so it's one thing to just grow and burn and grow and burn and grow and burn. But underneath all of that is the key inputs as to where employees are being added, where spend is being added. And is that spend being added in a thoughtful way? So maybe we'll jump to that slide, but I want to talk through this a little bit. Upper left-hand corner, gross margin, very straightforward, right? Huge input to the rest of the P&L and ultimately the profitability of the business, something that most companies will manage and measure. The rest of these buckets, sales and marketing spend, R&D, G&A, actuals versus budget is really important. So I'm going to pick on G&A here for just a second, right? Let's say that the business is growing 100%, $20 million in ARR, great performance, great expansion. And let's say that across that base, we've got, a 100% growth in our sales and marketing spend. If we're also growing our G&A and R&D spends at 100%, despite the fact that our revenue, our sales and marketing expenditure is what's driving the top line, at least directly. We've got to be very careful over time that doesn't put us in a position where we're over leveraged or overspending if the top line trajectory changes. So again, you want to make sure that you create a budget for each of these categories, and then you want to make sure that you're not getting ahead of the operating leverage that you should be experiencing. Doesn't mean you're going to cross cash flow break even at $25 million in ARR, though that may be the case, but it does mean that you have triggers in place that can help the business make very thoughtful investment decisions as it relates to its spend vis-a-vis the top line of the business. Okay, so it might be the case, for sake of example, that G&A spend is forecast to increase, but as we're going, some of the inputs on the top line start to change, and we say, hang on a second. We don't want that line to move. That needs to demonstrate operating leverage at this point going forward. So again, that's kind of how we think about the other categories of spend in the business, but it's very important that there's a deliberate decision that's made around spend categories. And there's drivers that vary on each of these, but that's why these charts are here.
Yeah, and I think it's a really important point. Let me double down on this for a second.
Sure.
You know, the thing we know about every budget is as soon as you approve the budget, it's wrong.
Yep.
Either you're ahead or behind budget from day one. So how should CEOs and CFOs think about? It takes. There's a lead time to hire folks, right? You've got this plan to hire certain people at different points during the year.
Yeah.
How should folks think about the stage gates around when to hire? Because ultimately that drives a lot of your spend.
Yes.
Versus the revenue traction against budget.
Yeah. Okay. So this is a really good question. I don't like, just to be honest, I don't love annual budgets because the decisions that need to be made within the first 4 weeks of approving a budget should be highly variable, right? So to the point, let's say that the business is assuming 150% growth. And let's just say that we have a pandemic, or let's just say that there's some kind of macroeconomic shift. I should, that very first month, revisit my assumptions on what spend I'm going to make, especially in fixed cost categories, right? So that the stage gating, it needs to be very thoughtful, right? It's like, okay, I have this team, I have this cost structure right now, and my assumption is that the market's going to continue to demand my product. And so 6 weeks from now or 8 weeks from now, I'm going to do a quick check-in to make sure, okay, we're sort of going in the right direction. Great. I'm going to unlock, the next, 3, 5, 7 hires as it relates to fixed costs. Again, sales and marketing, different animal. We're going to get to that a little bit later. But that's how I would think about it, right? So if I had in my budget, hey, I'm going to take my team and G&A, for sake of example, from 10 to 25 over the course of this year, I would not open 15 recs.
Right.
I would say, okay, I think that I need these 3 people in kind of Q1, and I need to be thoughtful about that. And at the end of Q1, if things have changed, stop. Be very, very thoughtful about those categories that you invest in, right? And that'll just allow the business to deal with the ebbs and flows that comes with markets, that comes with innovation. And if you do that thoughtfully, then you don't have to get to the end of the proverbial rainbow and say, crap, things are different than what we thought. Right. We got to make a bunch of hard decisions, right? So yeah, I think those stage gates are really good. Quarterly is good, but really the team that's in the trenches should just be thinking about this on a regular basis, right? Have things changed in the assumptions that we've made? And as soon as you start to see things change a bit, revisit the investments that you're making.
Yeah, perfect. Okay. From there, this is really focused on spend and the P&L.
Yep.
And ultimately, what drives value in a business is the cash flow of the business, right? Yep. In the long, in the 50-year out year, the DCF value is the value of the business. So, we're not typically looking at valuations based on cash flow in the startup ecosystem, but in the back of everyone's head, ultimately, we need to start generating cash at some point in the business's future. And today we need to monitor our cash because we're quickly burning down whatever cash reserves we have today. So this next slide, talk us through a little bit how we think about looking at cash flow and managing that in the business.
Yeah, so I'll double down on what you just said, right? This is not about valuations. This is about making sure that the business is creating value consistently with a combination of scale, growth, and cash either generation, burn, cash flow break even, what have you. That combination is really important. And I'll be the first to say the rule of 40 is helpful, but it's inaccurate as far as value maximization, right? But considering the cash burn dynamics in conjunction with scale and growth is really important. And if this is managed well over time, a business, even a business where growth rate comes off over time, can continue to create value. But if this isn't well managed, there are fairly jarring changes that need to be made, right? So that's why this is so important in my mind. So what are the metrics? How do we think about it? Monthly EBITDA, last 6 months EBITDA, free cash flow on a monthly basis, and then last 6 months of free cash flow. So the concept is fairly simple, right? If the business is growing at excellent rates, it makes a lot of sense to continue to fuel that growth, raise additional capital, make all the hires, investments that need to take place to fuel that growth. But as that growth starts to moderate, and especially as the scale gets bigger.
And it moderates for every company eventually.
Right. That's going to happen. And it's not a bad thing, right? What is a bad thing is if the cash flow dynamics are not managed in recognition of that moderation vis-a-vis the scale. And there's, again, every single month we have levers we can pull based upon the decisions we're making on cost investments that enable us to manage this, right? There's nothing that sort of forces us into any kind of value creation pathway. So if we look at this and we say, okay, look, we think it makes sense. Company's $50 million growing at, then the growth rate has come off. That allows us to be able to make the changes so that, we've got a rule of 50 company that's cash flow break even, growing 50%. Or if the business is $25 million and the growth rate is abated, maybe there's market dynamics, and you're a 40% grower, you can get to cash flow break even by utilizing these measuring tools, and then you're going to fuel as much growth as you can at cash flow break even. But it allows you to look at this and say, okay, I can balance top line, revenue growth rate, as well as my cash flow. And again, there's a whole nother discussion around that we could have, but you want to be able to see what's happening in the mirror.
Yeah, and this slide is really around the cash that we're burning or that we're generating. This next slide that we're going to talk through is more around your cash balance, your cash runway, and some of the metrics that help you, some of those levers that you can pull to either increase your cash flow or go faster.
Right. Yeah, absolutely. So this is what's happening month in, month out. If we go to the next slide, obviously you want to understand your cash balance trends over time, your cash runway. Cash runway is kind of funny because it's effectively a representation of this month's burn and what that would mean from a cash runway perspective. The way to think about it is, if my burn is reducing over time and I'm going to cross over to cash flow break even in 9 or 10 months, do I have enough cash to get there with a real buffer? And then you can kind of think about infinite runway, right? But it's a good metric nonetheless. You can kind of see what the cash runway looks like. And then obviously, cash cycle is real, even for a software company, right? ARR doesn't mean cash per se. And so measuring and managing to DSO, DPO, AR aging, traditional balance sheet metrics is really important.
Yeah, I want to double click on this for a second. Sometimes the difference between a founder owning 20% at exit and 5% at exit really can come down to how they manage cash.
Right.
You could have the same growth rate, you could have the same ARR scale, but if you're thoughtful about how you collect cash sooner and pay cash later, it can make a big difference in how much you end up owning upon ultimate exit of the business.
Yeah, it's fantastic. It's like the best way to fund a company, right? Is through your customer base. So that's great.
Okay, and then the last slide here in this section, in the finance section, with at least with the charts, is around share price. So we've been talking about creating value. A lot of folks will look to splashy press releases around the valuation of a company. We like to focus down on the share price of the company. Maybe walk us through why that matters and what we've done here.
Yeah, absolutely. So the first thing that I'll say here is this is not meant to be scientific. It's not meant to be independent. It's meant to be a measure of how the business is performing when you cut through all of the metrics and get all the way down to share price. And to your point, this ultimately drives every shareholder's value, right? So again, the concept on the left-hand side, let's have an estimation for what we think enterprise value is based upon a multiple, based upon revenue, based upon ARR trends. Obviously, growth rate changes, that multiple can change, scale changes, so forth. But we can estimate based upon our context of the market, what we think the enterprise value is each month as the business grows. And then we can calculate a simple back of the envelope share price that we think is representative of how the share price is increasing over time. The thing that I love about this is, again, not that it's an authoritative metric by any means, but I love this because this forces it enables the business to see at the end of the day, when everything is cut through, are we generating value through share price increases? Public companies, it's great, right? You can just pull up whatever index you want to pull up and you can see what the share price is. This creates some clarity so that we know, gosh, all these inputs, cash burn, dollars raised, growth rate, all of those things come together and we kind of go, okay, great. We're achieving what we want to achieve. So again, I would encourage folks, don't get too hung up on all of the inputs here. It's not authoritative, but it does give some good clarity on, hey, are we accomplishing what we're setting out to accomplish?
Yeah, the other thing I'd say it helps us do is understand the value of the business at any given point in time.
Right.
You know, a lot of our top performing companies will get approached with acquisition offers
right
out of the blue, right? And so you can have a good sense at any point in time of what do I actually think the business is worth based on real data.
Yeah.
And you can avoid getting lowballed or sucked into a process and ultimately lowballed because you know your value month in and month out.
Yeah. Yeah. And it forces a good consistent, again, board members from all different backgrounds, right, can understand this and have a different view. And so anyway, we found it to be a really helpful tool.
Perfect. Well, the last slide in this section is going to be very similar in all the sections. It's really key discussions. So we've just gone through all the data in the finance section. We want to understand, as the CFO, what's important to talk about with the board, right? Presumably, the board has read all these materials ahead of time, and this is where we want to spend the bulk of the time in a board meeting, is actually discussing what's important to get advice on or to get help on.
Yeah, absolutely. Again, a board is a resource, right? And so each team, each department should utilize that resource to discuss and get feedback and help and support in whatever category or topic.
Okay, great. Well, the next section is product. You know, after we've covered the financials and really framed how the performance of the business is doing, the next most important topic in our mind is to dive into the product,
right,
what we're building, where we're headed, and really the product is the core of any great technology company.
Right. Yeah, absolutely. So again, we frame the business. We now want to make sure that the business is investing in the product at a consistent rate, and we understand kind of how that investment is playing out. So that's what we'll get into here.
Great. So you'll recognize the first two slides. You know, these are going to be very similar in all the sections. What did the product team accomplish last quarter? And then what is the product team focused on initiative-wise for the current quarter?
Yep, absolutely. Again, consistent format. We like this format. Obviously, you can make tweaks, but we like to have the consistency. It's helpful.
Okay, the next one is what we call our product strategy one-pager. The idea is, how do you put on a single page where the product is today and where you're going? Tell us a little bit about how we try to frame this as a board discussion.
Yeah, so we're going to see in a couple of pages the more traditional measuring sticks that are used, product pipeline, what's coming in the next 6 months, right? And that's great, and it definitely has its place in the discussion. But one of the things that we found to be critical is that there is consistent quarter in, quarter out understanding of what the product vision and strategy is. And I can't overemphasize this enough. In my experience, it is not sufficient to build product, come to the board meeting or come to a discussion about where the company's headed and kind of say, hey, here's what's we're building next, and continue on, because markets change so fast over time that the meandering that can often result, customers ask for this, sales wants this, right? It needs to be much more deliberate than that. This page is pretty simple, but I'll just highlight a couple of things on here that I think are important constructs as companies put this together, okay? So the first is on the left-hand side, it says value proposition. So that's to suggest that there are a number of different value propositions that a company's product set will address over time. And that's going to create maybe a phased approach, but it's going to enable the board, the management team, the collective organization to say, okay, here are the problems we're trying to solve. Here's what we're delivering for our customers. And then you're going to get into the modules that address those value propositions. And one of the things that's really important is that those modules are constructed in such a way that facilitate the appropriate pricing and packaging, which we're going to get to here in just a second.
Right.
But I want to understand the vision. You'll see kind of a vision statement up the top as a subtext here, which is important. But then I want to understand, okay, here are the modules that play into this, and we're going to approach them in different phases so that we can deliver on the customer value propositions or the customer need, not just now or 6 months from now or a year from now, but over the course of the build process of this great enterprise, right? And I want to be careful. I'm not saying that you set this at the beginning and it's in stone and never moves. It's okay if this adjusts over time, and it should adjust over time. But what is problematic is when this is not communicated and it's not clear and it's not well understood. It's so easy to go day in and day out as an operator trying to solve the problems, deliver, sell, build code, whatever it might be. This is a very important anchor point for the management team, for the board. So again, the slide looks simple. It can be simple, but it's a very important way to say this is where we are, this is where we're going, and here's why. Now, let's zoom into the specifics. But I think that this is a really important dialogue to anchor to each quarter.
Absolutely.
That makes sense?
Absolutely. And the other thing I'd add on is, aside from the CEO role, the head of product is a really tough role.
Yes.
Because you have to take input from across the organization and your customer base, and then decide what it is that's important and what you're not going to do, even though someone might be screaming in your office that they need this particular feature.
Right.
So hopefully this tool and the discussion at the board level helps that head of product and the rest of the team come to clarity on what it is that we're building and ultimately trying to do as a company, and give a little bit of support to the product officer that really has a tough job.
Yeah. And I would 100% agree with that. And the other thing I would add is this should not be a guess. It shouldn't be a gut. This should be incredibly well researched. The problem set that the customer base or different types of customer personas is facing should be incredibly well understood, and the business should be incredibly diligent and deliberate as to what they're building. This is not about putting boxes on a page. This is about having a product strategy and vision that is very, very well informed and unifying across the organization.
And clear what you're building and what you're not going to build,
right,
and why.
Yes, absolutely.
Okay, well, let's jump in. Once you have that vision of the product, another really tough part about an early stage startup, and even as you scale, is pricing and packaging.
Right.
Walk us through how we think about this. And obviously, this is an ongoing conversation throughout the life of the business.
Yeah. And I like the next two slides because it highlights a key point. Board meetings are not about having every answer to every question. And they're also not about having perfection. It's about recognizing where we are, where we're going, and the continuous improvement that we're making to the business. So we have two slides in here: current pricing and packaging, future pricing and packaging. Right. And the concept is that markets shift all the time. Competitive threats shift all the time. So what do we have today? Well, maybe we have really one bundle and everything's kind of sold together. Right. And then maybe we have a little bit of an additional volume component or something like that. Let's understand where we are, and let's understand on the right-hand side of this, the fact that, we really don't have a whole lot of modules to sell. So that module sale on the right-hand side of this slide, it doesn't really happen. And therefore our expansion is kind of muted. That's okay. Let's understand it, right? This is where we are. And as you jump to the next page, that gives us the opportunity in conjunction with the product vision to say, okay, we're actually going to unbundle this, or we're going to introduce 3 new modules that are coming, and we're going to rebundle and refigure out what we're going to sell first, second, third, fourth, fifth to our customer base in conjunction with the value propositions that we're addressing. And now as I look at the right-hand side of this page, I can say, okay, I can land with this, Then I sell this 6 months later. Then this module gets introduced 6 months after that. And I go about addressing a more comprehensive problem set on behalf of my customer in a thoughtful way. If I've got this strategy laid out and I can execute in this way, now I'm able to take what I think might be the second most important metric, which is net revenue retention, and I can have real confidence as to how that's going to play out because of my product strategy. Not because I've got amazing expansion salespeople or whatever else, but because I've got this very thoughtful value creation toolkit for my customers to solve problem A, then naturally solve problem B, then naturally solve problem C. And again, this evolves over time. It might be the case that the customer says, hey, in order for me to buy your solution, I got to have bundle 1, 2, and 3. All right, great. Maybe that becomes ultimately the baseline. But having this type of discussion and adjustments over time in a proactive way protects you on net revenue retention.
The other thing I think it can really help you with is your sales cycle time.
Yep.
So the more that people can choose to buy a sliver of what they think they need, the quicker time to value you can get that customer. And then you can say, hey, by the way, here's these other 3 things now that you've been in the product for 6 months. It's very easy to understand why you would want this. Let's go ahead and add that on to your account. Where if you only have a single bundle up front or a single platform, it may be really hard to convince a buyer to move quickly if the ACV is too high or they view it as too complex to start.
Right. Yeah, absolutely. So super important, hopefully facilitates the right discussion, right?
Perfect. From there, once we've nailed down the product roadmap on a single slide, we've talked about pricing and packaging and how that might shift over time at the board level. Then it's important to understand how the product itself is doing, right? So this next slide is an opportunity to understand of the products that we've released, of the modules that are in the market today, how are the customers using it, and how penetrated are we within our customer base?
Yeah. In this slide, I want to be really clear. This is what's been purchased. Right. So this is modules and who's purchased which module and kind of what the engagement is, for lack of a better phrase, within the customer base around modules. Later, we're going to talk about actual usage, which is a different metric. But this is important as it relates to, okay, what white space do we have in our customer base, right? Super important.
The other thing that I like about this slide is it shows us, hey, we spent a bunch of time building this new product or this new module, and man, our adoption's only 10%. And It's been a year.
Right.
How did we make the decision to build that product? And how do we avoid that problem in the future where we spent a bunch of resources to build a product and we didn't get the adoption we expected to?
Right.
Or conversely, this product got 80% adoption in the first 3 months. What was so successful about this product, and how do we replicate that in additional features going forward?
Yeah, very well said. I think that's right on. So the next slide, I believe this is the last before kind of the discussion slides that we have in each section. This is the traditional product pipeline, right? So what's coming? What are the features that are coming? I want to highlight one thing. The way that this table is set up is value prop. So again, I want to tie each of the initiatives that the product team is building to a reason, a rationale around a value prop, and then there's another column that talks about economic rationale and what the expected adoption is. So following on to the comment that you just made, it's really important to say, hey, remember, we're building this for this reason. And again, this is in the product section of the discussion. We're going to get to engineering here in a minute, but it really brings some clarity as to we're very deliberate. Here's the vision. Here's how we're adopting, different modules. Here's what we're building, and here's the rationale as to why. And that creates a lot of clarity for where the business is going, right?
One other thing that is not on this slide, but we love when our companies add another column, which is pre-committed purchases.
Yeah, absolutely.
Right? So, hey, we're building this product. We've already gone out. We've interviewed 10 customers. 5 of them have committed to purchase $1 million worth once it's released. That's a great way to build a product organization and have it on the slide as well.
Absolutely. Yep. Well said.
Okay. This is similar to the rest of the sections. The key discussion topics you want to have with the rest of the board is the product team. And from here, we jump into the engineering org.
Yep. And same format, right? Accomplishments and kind of key priorities at the front end. Again, that consistency and dialogue around departments we found to be really effective.
Okay. So we've got this next slide in here around the engineering development process. Not every engineering org is broken, But generally, because our companies are moving so fast at the startup stage, you need to iterate and change the engineering org over time. So Brady, tell us a little bit about, it's a bit of a blank slide, but what you'd expect to see on this slide.
Yeah, and I want to go back to the comment we just talked through around pricing and packaging. Again, board meetings are not about perfection. They're just as much about continuous improvement and pulling on the right levers given the circumstances and the stage of a given company. So I really like this because it says, hey, here's where we're at. This is how we do things today. We recognize that there's additional tools, there's additional approaches available to us at all times. Maybe we're moving towards an outsourced model. Maybe we're moving away from an outsourced model. Maybe we're layering AI into the development approach, whatever it might be. But this gives an opportunity for the engineering department to say, hey, here's where we're at, here's where we're headed, and here's the rationale for that. We get at this from a lot of different metrics in other departments, in particular go-to-market. But I think this is a great way to just say, hey, how do we do things today? How are we going to do things tomorrow? And it facilitates that continuous improvement.
And again, going back to our earlier discussion around system efficiency, this is the start of understanding we're spending dollars on expensive software engineers.
Right.
How do we make sure that we're getting the most out of that organization? And this is an opportunity for the head of that organization to say, here's where we are today, here's where we're going to tomorrow, and here's why that's a great investment for all the shareholders of the business.
Yeah, absolutely.
Okay, so let's get into some of the metrics we like to see within the engineering org. Brady, talk us through what's on this slide and why we think these are so important.
Yeah, so we tried to be really targeted here. There's one slide, 4 different metrics. A couple of them are very traditional, and I think that makes a lot of sense. But these are really the ingredients for building the product vision, right? So number one, we got to make sure that the uptime is there. We all remember, a major event where we didn't have access to internet or didn't have access to our cell phones or some app or whatever it might be. So that's important, right? And whatever the right metric is for sort of consistent stability is the right way to think about it. Upper right-hand corner is really the balance of the org. So we've got kind of some generic buckets here. How much time is being spent as a percentage of the whole on bugs, sustaining innovation, right? So things that we're doing to just kind of continue to get better, and then new module design. With the construct being, we're building new modules so that we can sell modules in addition to what we sell today. And having a good balance there and understanding where we're spending time is really important. Bottom left-hand side, headcount. Bottom right-hand side is kind of the individual contributor to manager role ratio. Both of those are really important to your point on system efficiency, right? If we get to a point where our manager to engineering ratio is off, we've got a lot of expense and probably less code being developed or product being developed than we had anticipated. So really, just a really good way to understand what's happening in such a critical part of the organization and be able to do so in a quick fashion.
Yeah, what I'd add here is in a lot of board meetings, it can be a bit of a black box how well the engineering org is producing new code,
right,
or new modules. And so the idea of this slide is to help frame for the board and for the management team how effective is our engineering org, and do we need to make any changes, or how can we help them continue to be very effective going forward?
Yep, absolutely.
Okay, with that, I think we'll jump into the go-to-market section. We spend a lot of time here at Sorenson Capital helping with the go-to-market. Excited to talk through how we think about this.
Yeah, absolutely. And just to review the agenda one more time, we now understand CEO priorities, right? We understand the performance of the business, and now we understand the key inputs to the product development engine, right? Critical for the future success of the business. With all of that, now we turn our attention to, okay, are we getting this great product to market? We know this is the key driver of valuation. We know it's the key driver on value creation as it relates to share price. So let's get into the metrics that effectively contribute to our success or lack thereof, right? So we're going to talk about 2 different major sections: generating leads, closing leads, right? And each of those has a lot of different metrics therein. What we're going to do is we're going to frame how the system is working for purposes of highlighting the bottlenecks. These organizations are moving in many respects the fastest as a company is scaling, which means that staying in front of issues, staying in the center of the highway as the company scales, can pay massive dividends And that's what we're about here at Sorenson, right? Is bringing those toolkits and playbooks together so that we can stay away from the problem spots that are going to create a period of reset, right? And that's what the metrics are about. So with that, why don't we dive into lead gen? So on the first couple of pages of this section are going to look very familiar. Yeah. It's the same format, right? We're going to talk about key accomplishments and key initiatives, which is great. So in the lead gen function, there's really two buckets that you and I spend a lot of time on, activity and pipeline. And what I would tell you is both are insufficient. And each one is insufficient. Together, they create a very helpful picture. And that's why we have kind of both approaches here. So there's a lot of metrics, but what you're trying to understand is, are we getting enough ingredients into the top of the funnel to give us the right opportunity set we're looking for at the bottom half of the funnel so that we can hit our top line numbers, right? So the first thing we get into here is activity metrics. So there's a number of different activity metrics. Every business, every go-to-market motion is slightly different, but the concepts here I think are pretty consistent. First and foremost, are folks getting familiar with our company? They may not be shopping for a solution, but are we getting enough views, enough engagement, enough understanding in the market for what we do to be able to foster actual lead generation? Traditionally, web traffic, visitor counts, whatever it might be. The top right-hand side of the chart is new initial contacts by source. Again, this is a very low level of qualification, but are we having discussions with folks who may become leads on a regular basis? And what is that volume, right? And then are we having shifts as it relates to where that's coming from? All right, you and I work with companies that have a very high base of referrals. And that's great, and that may work. That may be the best way to go to market. But we want to understand ebbs and flows, right? If we see a truckload of leads come in from a particular source that's new to us, and we see the conversion rate on those leads is very high, we're obviously going to want to turn our attention, right? The bottom left-hand corner, I want to be very careful with this. I'm not fixated on whether it's a discovery and whatever that means, or a demo and whatever that means. What we're trying to measure is effectively folks who are really evaluating us. They're actually going to buy,
right?
Or they're going to purchase a solution. They actually have a problem. They're motivated to adopt, right? That's what we're trying to measure in the lower left-hand corner. Is whatever that first gate is. Maybe these are stage one leads, whatever you want to call it. But what I want to highlight is that orange line. What are the total demos, stage ones, whatever you want to call them, required to hit plan? Well, how do you figure that out? Well, let's say we want to grow 100%, and that means that over the course of the next 90 days, we need to be able to achieve X amount of ARR, and let's say that our sales cycle is 45 days. Well, you can do the math and back up and say, okay, well, that means I need to have X number of new stage ones in this period of time in order to deliver what I need later in the quarter or month or year or whatever based upon the sales cycle. That, I think, is the most important message of what we're trying to highlight here is you need to do the math. Companies need to do the math. Go-to-market organizations need to understand what activities are required so that you can get the pull-through later in. So the chart has whether it's sales-generated, marketing-generated, total leads, right? And how does that compare to what we need to have? And you can see there's a buffer there in the chart, which obviously gives us some comfort. And then as you go to the right, this is simply more qualification. Opportunities generally are qualified at a higher level, right? So you want to be able to understand, okay, is my volume there? How does that compare against what I expect to achieve? And then what is my cost, right? Is my cost per opportunity shifting over time? So again, activity metrics, part of the equation, an important part of the equation, but at least you know, okay, the right things are happening to likely create pipeline, which we're going to talk about here in just a second.
Yeah. Two things I double click on real quick here, Brady. The first is we didn't call this marketing.
Right.
We called this lead generation, right? And I think that's pretty intentional in that lead generation typically is not just a marketing function. It's not just a customer success function. It's not just a sales function. Collectively, someone needs to be responsible for generating leads.
Right.
That can be the marketing leader. That can be the CRO. But the idea of this section is, are we generating enough leads and who owns that generation?
Right.
The second thing I'd say, that bottom left-hand corner, you touched on the orange line, right? What is the total demos required to hit plan? It's been interesting as we continue to work with companies. A lot of folks have a ARR target for the year. They have a revenue target for the year, but they haven't worked that all the way back to a lead gen target for the year or a lead gen target for the quarter. And so the idea is this is a forcing function to roll that plan all the way to the top of the funnel and understand how many leads you need to be hitting day in and day out, week in and week out, to ultimately hit your revenue target for the year.
Yeah, and I love the way that you said that. And if I put myself in the operator's shoes, what that allows me to do is know on January 10th whether I'm headed in the right direction or not, instead of waiting until the end of Q1 and figuring out if we hit our number or not.
Right.
And that connectivity allows for the business to make adjustments very early, right, in the year or the period, so that the business can accomplish its goals, right? We talk a lot about predictability. These are the ingredients, right, for predictability.
Right. Okay. From here, we move from activity metrics into the pipeline. It's important to understand what activities generate pipeline. Once you've got pipeline, how do we think about that?
Yeah. So pipeline, very common metrics, right? And I think they definitely have their place. They're important. The challenge is it's really hard to know the quality of the pipeline. It's really hard to know whether my pipeline value is accurate, right? Especially at a stage level. So in combination with activities, if we're doing the right activities and our pipeline suggests that we've got enough coverage, that's usually a pretty good combination for hitting numbers, right? Generating leads and hitting numbers. So the first thing we want to do is very similar mindset, right? We want to understand, okay, how much unweighted pipeline should I be generating in January so I can hit my number in March or April or what have you? And that's the top left-hand corner here. And that comparison, you can highlight where you've got issues. Now, you can go cross your fingers that your conversion rate's going to go up on lower pipeline, but we all have experienced that. That's a painful way to manage, right?
Right.
So we want to make sure we're generating enough pipeline. Then yes, we can track pipeline value over time. This is probably the most common way to think about the pipeline. But again, there's a lot of nuance there. We want to understand unweighted pipeline, weighted pipeline. And then bottom left is to really, again, draw that connection. How much pipeline do I have, weighted, unweighted, but how much new ARR do I anticipate resulting from that pipeline? And how do I feel about that coverage, right? If I've got a weighted pipeline of $10 and I anticipate closing $15, that's a problem. On the flip side, if I've got a weighted pipeline of 10 and I anticipate closing 7, I feel pretty good about that, right? But most importantly, if I generate $10 of unweighted pipeline and I think I needed 7 in this period of time, I've got high confidence as to what's going to happen in the future. So again, lots of different inputs on achieving predictability in the motion, but we think the combination is the right way to do it. The other thing I'll hit, bottom right-hand corner, is really important. Understanding the average age of opportunities by stage in a pipeline is a way to kind of make sure the pipeline's not lying. That data is really good at lying to go-to-market leaders. But if you understand the average age and you understand there's consistency therein, you should be putting new pipeline in the top of the funnel, seeing pipeline come out the bottom of the funnel, and have consistency and predictability there. So this is the first page on pipeline metrics, right? The other thing that we do want to look at is pipeline progression, which is the next stage. And again, the next page. The data is pretty consistent, but this is just to break the pipeline into pieces and to basically understand, okay, what's happening to my proposal stage, what's happening to my negotiation, commit, contract sign, what have you. Again, very common in combination with the metrics we just went through on pipeline and activity. This gives a really good sense for how the lead gen funnel is functioning today.
One other thing I'd say here is what's critical is to have very defined criteria for moving something from one stage of the pipeline to the next, right? If you have garbage in data, you're going to get garbage out data.
Right.
So what we spend a lot of time with our portfolio companies helping them is once they've cut this data, having very clear, again, stage gates or criteria that has to be signed off on to move something from a proposal to a negotiation to a commit. And that might look like, getting the buyer with buying power on the phone. That might look like just having a meeting.
Right.
But whatever it is, having clear and consistent criteria helps you ensure that the data here is actually useful in predicting what's going to happen versus one rep may say this is one stage, a different rep may say it's something else, and you never really have any confidence in your future planning.
Yeah, absolutely. Yep. I think that plays an important role. So the next section here goes into win rates, and we talked about lead generation, lead closing. We're going to absolutely take the win rates discussion and put it after the lead closing, right? But it's very connected to the pipeline metrics generally. That's why we put it in this section from a discussion point perspective. But let's go through this. There's really two concepts that I think are really important. I would say win rates is certainly top 5 most confused topic as it relates to go-to-market motions.
Yes.
And so we wanted to try to bring some clarity to that. So on the page here, the left-hand side is intended to be simple. If the customer makes a purchase decision, decides to purchase a solution, how often do they buy us versus the competitor? Sometimes we have data on this. Sometimes it's hard. Do your best. Try to understand how you're performing when the customer does decide to make a decision. But the right-hand side is a couple of different things. So you're going to have buy competition if you can get it. But what's often a little easier to get is they made a purchase decision. Did they purchase us or did they not? That's a win rate, right? In our nomenclature,
right.
Sorenson nomenclature, that's a win rate. So let's say that, every time we know the customer bought, they purchase our solution 60% of the time. Great. We have a 60% win rate. That's helpful. We want to track that over time and make sure that we understand any movements because that's going to tell us how our product is performing in the market. But the other thing that's really important is what we term close rates. And this takes into account the fact that customers sometimes decide not to buy. Maybe they run out of budget. Maybe they decide they're going to punt this problem down the road. And that close rate can also be really helpful. And that's to say maybe that, in every opportunity that we had a shot at, including those where they didn't make a decision, what is that close rate? And that number might be, 25% of the time, 30% of the time. That doesn't mean that we're not the preferred solution, but it does mean that we understand on the whole how we're trending on a close rate over time. So those two concepts I think are really important, and we've tried to lay those out in a way that can provide some clarity to say when the customer buys, what's the win rate? And then holistically, whether they buy or not, how frequently are we closing opportunities that we're pitching on? For lack of a better
word. I think about close rate as being used to predict how our business is going to do.
Yep.
I think about win rate as our strength in the market and how strong our product is relative to our competition. And is there an issue or do we continue to be the front runner in the market?
Yeah, I think that's well said. And then the next couple of slides here, same thing, right? Discussion topics on go-to-market.
Okay.
For the lead function.
For the lead function.
Yeah.
And then after leads, we get into the sales function. Again, these slides are going to look very familiar. It's what did the sales team accomplish last quarter?
Right.
What are some of the initiatives that the sales team is working on for this quarter? And then we get into, we talk a lot about effectiveness, but this is specifically around the sales team and some of the unit effectiveness here. So Brady, talk us through how we think about some of our favorite metrics.
Yeah. So again, we've gone through activity metrics, pipeline metrics. Now we're talking about to your point, the effectiveness of the team that's actually closing deals, right? And what that looks like, because it's going to drive value creation in many respects. So what we want to understand is capacity, attainment, unit economics, and ramp time. Okay. So as we think about that, let's just start with each of those. They're key contributors to the health of the go-to-market motion. So quota capacity just simply says depending upon the number of AEs I have and the quota that those AEs have been assigned, including a ramping quota, right? So if I was hired 60 days ago, maybe I only have half of my general target for a particular month. But that total number in each month is my quota capacity. And if I have, $100 worth of quota capacity, and my plan says that I'm going to close $130 of new ARR, I effectively am assuming that I'm going to achieve at 130% of quota. Very atypical.
That's a tough spot.
Tough spot to be, right? You're very likely going to miss. So the first thing we want to understand is just simplistically, do I have enough quota? Do I have quota coverage that's sufficient? Generally speaking, we counsel folks that, 70, 80%, good place to be. fairly common, right? But you want to make sure that the ingredients are there to be successful. That's number one. Number two, we actually want to understand what our attainment is. So we have good ingredients. We've made the right investments from a headcount perspective. Number two is, okay, what is our attainment? And each of the dots on this chart, upper right-hand corner, is a rep. And we're charting that rep's attainment in that particular month vis-a-vis their quota. And then you can run an average chart or an average line that basically says, okay, across the whole base, what's my average attainment? And then I can compare that to target. So in one chart, I understand the entirety of the AE base, how they're performing, and what the trends are. This is super, super helpful, right? If I'm in a situation where my attainment is 50% or less, I don't have a capacity problem, likely, right? We've looked at that previously. I've got an effectiveness problem. That could be lead gen, that could be training. There's a lot of things that could go into that. It could be product, but I want to understand that, right? And that attainment is going to drive a lot of things in unit economics. The next chart is what we call OTE return. This is the unit economic metric that we use and that we rely upon. So let's so the chart is set up in a very similar way. Every dot is an AE, and what we're trying to measure is the return on that AE's cost. OTE, on target earnings, return. So if a particular rep costs, $150,000, let's say, on target earnings, and that rep is generating $300,000 of new ARR in a given period, that OTE return is 2x, right? And so what we're trying to do is we're trying to say, okay, so what's my average OTE return? And the general target is roughly 3x, assuming you've got SaaS-like gross margins, 80%, right, ish. If the gross margins are lower than that, it can still work. It's just that your OTE return target needs to go up in a proportional way. So maybe you're trying to hit 5x OTE return, for sake of example, depending upon your gross margin. But this allows us to understand, okay, I got enough capacity, great. I got the right ingredients. Number two, my reps are attaining at a reasonable level. My quota levels are appropriate. Maybe my quota needs to go up. Maybe I've got training problems I need to address. My OTE return is appropriate. So I've got good unit efficiency. So I'm getting what I need out, and that's going to help us with CAC payback. It's going to help us with Rule of 40, cash flow, all of those things. And then the bottom right is, okay, well, I'm likely, if I'm growing quickly, I'm likely going to be adding reps. So how long is it going to take me to ramp a new rep once I decide to hire that person? And so we're tracking, okay, if I hire X number of reps over the course of the last couple of years, what's my average ramp time, right? And success rate, for lack of a better term. But these metrics allow us to look at the business and say, how well are we doing in getting the customer signed? And we found these metrics to be really, really helpful in diagnosing issues.
Absolutely. And I think the other thing that it does is it helps frame the business, not just for the board, but for the sales leadership team.
Right.
I think a lot of times the sales leadership team does a lot of this work at the beginning of every year to set quotas, to set the budget. And then we get into the quarter end drive to close as many deals as possible. And this is helpful to take a quick step back and just understand, as an organization, how are we doing as the sales org? And are we getting the efficiency that we were hoping for? Not just did we hit the number that we thought we were trying to hit for the quarter.
Right, absolutely. And along these lines, right, this is unit efficiency. This is going to tell us, okay, are our AEs or our pods working well? Do we have enough capacity? All of those things. But the other thing that is going to drive system efficiency, CAC payback, some of the other things we talked about, is the structure of the team. And that's the next category here that we want to look at. And the last category within the closing leads section, right, of this discussion. And that is how the sales team, marketing team is staffed, okay? And the way to think about this is, if I have, depending upon how many people are actually closing deals, have a quota, bringing in new ARR, recognizing that there's a lot of people that could be helping with that. But if I don't have enough people vis-a-vis the total staff closing deals, I'm going to create inefficiency. On the flip side, if I have too many individual contributors that are all AEs and I don't have enough kind of support around them, they may not be efficient. They may not be effective, right? So there's a balance there. So we're trying to do two things. So on the left-hand side, we're basically laying out the structure of the sales and marketing organization, very similar to the chart that we had in engineering or product, right? And we're trying to understand, okay, my leadership structure, how does that look vis-a-vis my AEs? My BDRs vis-a-vis my AEs, my solution engineers vis-a-vis my AEs, RevOps, marketing, what have you. And what I'll point to is on the right-hand side of this slide, if the percent of the sales and marketing team that carries a quota is too low, then there's a lot of cost that's not directly driving new ARR. And that will result in frankly, poor CAC payback. So again, it's one ingredient. You can do great at this. If you do great at this and your unit efficiency is not there, you're going to have poor CAC payback. If your unit efficiency is there, but your structure of the organization is not appropriate, or there's not enough AEs vis-a-vis the rest of the headcount, you're going to have poor CAC payback. But the combination of these metrics being appropriate, greater than 50%, for sake of example, of your go-to-market organization actually carries a quota, then you're going to have, and along with a 3 or 4x OT return, that's likely going to result in a great CAC payback and therefore system efficiency. So again, the combination of these two slides, I think, is really important in helping to maximize the health of the go-to-market motion.
Perfect. Couldn't have said it better myself. Okay, great. That's the end of the sales section and the broader go-to-market section. Next, we want to touch on customer success, which in some cases can be under the go-to-market leader.
Yep.
Sometimes it's separate, but in a lot of ways, it's its own unique animal. So wanted to touch on that here. And to start off, you'll recognize a lot of the same slides.
Yep.
What did we accomplish? What are our initiatives for this next quarter?
Right.
And after that, we get into the specific metrics that we like to see within the customer success org.
Yep, absolutely. So customer success, there's lots of different metrics going to be utilized. We'll go through a few, primarily around the health of the customer base and how that translates to the renewal process. Again, we talked about gross retention, right? A critical metric. So this first page is really to show a number of different inputs that are going to contribute to the health of the customer base. So the first one is the top left-hand corner, not a common metric, but I think something that's really good at pointing out potential issues. And this is booked but not yet implemented ARR. So one of the challenges that can happen is customer gets really excited about the product, signs the contract, supposed to be implemented in, pick your day, 30 days, and 6 months later, we're still trying to get it right. That's a real problem as it relates to customer success. So what we've done is we've said, okay, let's chart the not yet implemented ARR. Let's also chart how many days on average it takes a customer to realize value, which could be measured a few different ways. But let's just make sure we don't have this pile-up effect that ultimately is going to result in a bunch of churn. Right? Super important, I think a helpful way to think about this. The next one is NPS, very common metric. Different companies will solicit NPS scores at different intervals. So we've just kind of said, hey, keep an eye on the last 12 months NPS scores, whatever the frequency is, what the last 6 months is, what the last 3 months is. Just make sure that you don't have some deviations that are starting to scream an issue, right? And then similarly, on the bottom left, average ROI. I do want to hit on this for a second because I think it's really important, especially in today's market. It is more common than ever that the customer base, the buyer, the user of the software is thinking, what is my ROI? Spending $150,000 on this software, what am I getting for it? It's not good enough anymore to digitize a process because you should digitize a process. It's got to be very clear the ROI that's being generated. So we encourage companies in our portfolio to figure out the ROI calculation, whatever it might be, right? Are you saving heads? Are you generating more revenue? Whatever the ROI metric might be. Are you saving time? Are you automating processes? But try to understand what that ROI is and measure it over time so that you know that your customer base is benefiting. And if they were to turn off the solution, that it's gonna cause pain, right? That there's gonna be real cost of doing that. And then the bottom right-hand corner, which we're going to hit in depth here in a second, is the renewal rate. So how are our renewal rates tracking over time? This is meant to be a dashboard that's a one-pager that says, great, generally speaking, I know how I'm doing from a customer base perspective.
And how I'm trending.
Right.
Right. Again, it goes back to data and context. We have to understand where we were historically and where we are recently. And that's what we've tried to lay out here.
Yep, absolutely.
Okay, like you said, this is the kind of double click into renewals, right? How our customers are doing. Walk us through why we like this view on the top and some of the detail underneath.
Yeah, so if I had to pick a chart that's one of my favorites, it's the top chart here. And the reason for this is the general measure is gross retention, as we've talked about, or you translating that into a renewal rate. What we really want to understand is what came up for renewal and how much of that renewed. You got multi-year contracts, that's going to be different than gross retention. But I want to understand, I had 10 opportunities to renew, I only got 9 of them, or I only got 6 of them, right? And understand what the drivers are. So the chart is renewed, not renewed in a given period, what the renewal percentage was. And then really importantly, on the right-hand side, those gray bars is what's coming up for renewal. Very important thing to be thinking about, right? So I think this is a great way to kind of figure out, okay, how are we doing on our renewal base, despite how the metrics can go on gross revenue retention. Reasons for non-renewal, obviously very important to understand. And then look, if there are upcoming renewals that are major, list them, because this is an opportunity for you to say, hey, board, these are really important customers. We'd love any help you can provide, in making sure that we're delivering excellent value for these customers. Anyway, so I think it's a really great way to provide intelligence and level set on how the renewal process is going.
Perfect. Agreed. This next one, I think this is the last slide under customer success. This is really trying to get into the health of the customer. So, we can look at the upcoming renewals, we can look at how we're doing, but we want to get ahead of that and understand ahead of the renewal. Are the customers using the product? Are they happy with the product? How is that trended over time? And these metrics are intended to do that.
Yep. I think this is a great way. So we talked a little bit before about adoption or the modules that are being purchased by the customer base.
Right.
This is going to what is more important, or at least next most important after that, and that is the module actually being used.
Right.
I may have paid for that module, but if I really never engage with it, I just had a salesperson that was good at selling me the module, I want to know that, right? So upper left-hand corner, this is usage, maybe daily, weekly, monthly, whatever the kind of right frequency is, but understand your usership. If your usership is going up faster than your growth rate, that's a really good indication for what's to come. On the flip side, if it's growing at a slower rate than your growth rate, there's real engagement problems in the product set or in the customer base. And then again, adoption in the upper right-hand corner, this is really usage, right? So this is, okay, give me the modules, give me a sense of the folks who are actually purchasing them, what percentage actually use the product.
Right.
Really important. A lot of companies have a volumetric component of their revenue model. You should measure that, figure out, okay, what the key drivers are for revenue and how is that volume trending. You may have buckets. You want to know if the volume is starting to drip to the bottom of the bucket, because you're likely going to have downsells if that's the case. So whatever is appropriate for the company, be thoughtful about that. And then bottom right-hand corner, the last point I'll make here is I want to understand that there should be some view from the customer success base for at-risk accounts. And usually It's like, hey, here's my red accounts, here's my yellow accounts, here's my green accounts, whatever it might be. Give me a sense for the total ARR that's either yellow or red and how that's trending over time. Every company's going to have accounts that are on the yellow-red bucket. Right. I want to understand what the impact is likely to be. So give me a sense. Well, the total customer base is $40 million in ARR. I've got $8 million in ARR that's at risk. That used to be $2 million. But over the course of the last 3 months, it's turned into $8 million. Flag, right? We got to talk about that. So anyway, it's a really good way to kind of highlight that without massive lists of customers and colored Harvey balls, right?
Right. Yeah. I think of this bottom right chart as the summation of the other charts here, right? We're trying to understand what is the behavior of the customer, and then we take that behavior and turn it into, is that customer likely to churn? Are they at risk? And how do we summarize that into an ARR figure?
Yeah, absolutely. So I think that's it on the customer success side. Last but probably most important, people. So the people section is a really good opportunity to just pull up and say, just as it's important to understand the health of the customer base, what's the health of the people universe, the employee base in the company? So we start with accomplishments, it's going to look very familiar. We start with initiatives, that's going to look very familiar. And then we get into the analytics, right? And the analytics on the people side, again, there's a handful of charts here, but there's a couple of things we want to understand. Headcount for sure by department. That's a really good reference guide. It allows the board to understand at any given point of time, how is my employee base broken out, right? And what does that look like? Where have we made investments? And then turnover, planned versus unplanned, right? There's probably a very consistent, maybe planned adjustments, performance-based, whatever it might be. But you want to understand if you start to have real movements that are unplanned. That's the upper right-hand corner. Satisfaction scores by department, critical. Understand where there's likely issues within the employee base and where the leadership team can shore that up. And then the bottom right-hand corner, I think, is really important. How many roles are open and what's our average time to fill those roles, right? If we have particular roles that have been open for a long, long time, we should understand that. Or if we're getting really good at filling roles, that's great. That means that we can make a decision to hire a role and have that role filled in a short period of time. So I think it's a good way to understand, okay, how healthy is the organization? What are the areas that we need to focus on? And then the next slide is really around key opportunities to build the base, right?
Yeah, exactly. Yeah, this next slide is really around a company may be hiring 100 people at a time, but this is an opportunity to ask the board to help out. And look, we're looking for a new CFO or we're looking for a VP of engineering, those high impact hires where the board may have previous connectivity with a great person from another company. How can the board help the company get those great people in the door?
Yeah, absolutely. So again, people is critical, right? Everything starts and ends with the team. So I think this is a really important way to make sure that the leadership team is kind of watching closely. The last slide here is just around other discussions, strategic discussions that need to be had at the board. There should be room for that. Most of the time, those discussions have taken place, but it's a good opportunity to set aside time as necessary. But again, hopefully this gives our audience a good understanding for how to have consistent dialogue, how to make sure the business is well understood, how to make sure that you're facilitating discussion around the most consistent or most important topics consistently. We found this format to be really useful. It takes a little bit of the guessing out of kind of what the key, how to structure the deck, how to make sure that I'm getting the right feedback and so forth. So hopefully it's been a helpful dialogue.
Hopefully it's to ultimately have the right conversations in the board meeting, right? If you can all see the data the same way ahead of the meeting, you can come prepared with the key discussion topics, then that board meeting's a lot more productive than if people aren't seeing the data the same way.
Yeah. Well, really appreciate the discussion, Jeff. It's been great to work through this. Hopefully the audience has benefited from the discussion. And until next time, thanks for talking through it.
Anytime.